Hello and welcome to Stock Market Fever. Today is Monday, April 18th, and in this video we will analyze 5 stocks that Jim Cramer says you should sell. NortonLifeLock, symbol NLOK, is world famous for providing cybersecurity solutions. During his show's lightning round on April 12th, Cramer was pessimistic about the stock. Jim Cramer has a sell rating on the stock, according to Mad Money Stock Screener. But if you had bought NortonLifeLock 1 year ago, you'd be up about $5 per share for a 23% return. Hey, that's nice! But if you purchased it at the beginning of 2022, you'd be up a grand total of only 66 cents, which is better than losing money, but meh. On March 29th, Morgan Stanley downgraded the stock from overweight to equal weight with a $28 price target, citing, quote, slowing sales and the macro environment as reasons for the company's revenue estimates to be revised downward. As of April 14th, Zacks has a sell rating on the stock. But not all analysts are as bearish. While Schwab Equity downgraded the sentiment in NortonLifeLock this past week, it still rates the shares with a B buy rating. And as of February 4th, with the stock trading at $25.38, research analysts CFRA maintained a hold rating, citing good profit margins and customer loyalty offset by an increasingly competitive environment. And while Stock Market Fever does not offer investment advice, we note that NLOK offers good swing trading potential. This year it has tested its base support of about $25 a couple of times and has met a ceiling of about $29 a share on 3 occasions. We see no reason why this pattern shouldn't continue for the next several months, and believe that predictable patterns create excellent swing trade opportunities, in this case buying at about $25 and selling at about $29 repeatedly. The second stock we'll look at is Nflx, symbol Nflx. Jim Cramer was fairly pessimistic about Netflix prospects on his April 14th broadcast. He felt that consumers now have too many streaming options, and that could take some of the wind out of Netflix sales. If you had purchased Netflix 1 year ago, you'd be down a whopping $205 per share for a 37% loss based on its close of $341 on April 14th. Ouch! And if you purchased it at the beginning of this year, you'd be down over $261 per share for a 43% loss. No wonder there is bearish sentiment on the stock. On April 14th, Morgan Stanley lowered their target price from $450 to $425, maintaining an equal weight rating, and this follows 3 other analysts lowering their targets this month. While it is possible that the stock has been oversold and the stock could rebound, Stock Market Fever is not very bullish on their prospects and agree with the overall general hold consensus. The third stock we'll analyze that earned Cramer's bear breath is AT&T Inc., symbol T. In a broadcast in late March, Cramer indicated that the company was performing terribly and was simply not a great company. If you had purchased AT&T shares a year ago, you'd be down about $3 per share for a loss of about 13% based on Friday's close of $19.54. But if you'd purchased their shares at the beginning of the year, you'd be up about 97 cents for a positive return of just over 5%. Meh. But AT&T seems to have bounced back a bit after showing base support at just under 18 through much of March, and since Cramer's negative outlook, the stock has bounced up a bit to close just under $20 per share. They are expected to report earnings on Thursday, April 21st, and according to Zacks, Wall Street expects a year-over-year decline in earnings on lower revenues. Wells Fargo and Morgan Stanley have both lowered their price targets in April to $21 and $22 respectively, and with the stock currently trading just under $20 per share, Stock Market Fever believes that this is not a stock to get excited about. If the earnings beat lowered expectations, it might give the stock a short-term lift, but not by much in our opinion, and we therefore do not believe this is a good buy opportunity. The fourth stock that Cramer was pessimistic about is Gore's Guggenheim, symbol GGPI. He will not give it a buy rating as it does not make money yet. Perhaps Reuters' description of Gore's Guggenheim as a, quote, blank check company should give investors pause for concern. Reuters notes, the company is formed for the purpose of effecting a merger, capital stock exchange, asset acquisition, stock purchase, reorganization, or similar business combination with one or more businesses. The company intends to focus in consumer products and service industries. The company has not conducted any operations nor generated any revenue. Okay, as far as Stock Market Fever is concerned, that is reason enough to stay away from this company. However, there has been much buzz about George's Guggenheim's agreement to merge with Polestar, a global pure-play electric vehicle firm with a lot of promise. And Gore's Group is a recognized sponsor with long track record of successful agreements and potential deals in the pipeline. And Polestar outperforms Rivian and Lucid, which are both valued at substantially greater multiples in terms of sales and output. And Polestar will be able to swiftly expand in the next few years thanks to strategic commercial agreements with Volvo and Geely. However, the electric vehicle car field is getting crowded, and it is unknown what competitive pressures will do to profit margins. But after Cramer's throwing shade on the stock, an anonymous commenter on Yahoo Finance noted, "It was pretty obvious yesterday that on Money Madness, Cramer wanted to say yes to GGPI, but couldn't because they don't make money yet. By those rules, he wouldn't have bought Tesla even at $10. Polestar sells more electric vehicles than Lucid or Rivian. Just a matter of time before Cramer flips to pound the table, buy." And what Stock Market Fever's call on this stock? Highly speculative. Could be a big winner, but could also be a big dud. For the fifth stock that Cramer was pessimistic about, we turn to Meta, symbol FB, more commonly called Facebook. In his April 11th Mad Money show, Cramer gave the stock a sell rating in his belief that with markets facing tremendous turmoil due to macroeconomic conditions, now is not a good time to be in tech stocks. Zacks Ratings is also bearish on Meta, giving the stock a rating of 4, sell. Facebook has, of course, been on a wild ride over the last year, gyrating between a giddy high of 384 at the end of August and a recent low of 185. It has come back from that low recently into the 220 range, only to start dipping back down to its close on Friday of 210. Not all analysts agree with Cramer, however, and Schwab rates Meta stock with a buy outperform rating, as does UBS, which raised its target of 280 up to 300 on April 5th. Stock Market Fever, while not terribly bullish on the stock, believes that money could be made if the stock dips, and swing traders take advantage of its ranges between 200 as a buy point with 230 as a sell. But what do you think? Which way do you think these Cramer dogs are headed, and why? Please leave your thoughts and comments below, and be sure to subscribe for future alerts right here at Stock Market Fever.